And we're live. G'day. This is Xenium.Live, all things money, finance, and property. I'm your host, Scotty North, and today is a Thursday, 2:30 in the afternoon. So grab a cuppa and a cookie and join us for some great content. Well, on today's show, and every fortnight, we have the wonderful, the only PJ Patterson joining us from Keystone Financial. Hey, PJ, how you doing?
I'm good, Scotty. How are you today? Sounds like everything's going well up there in sunny Queensland.
Mate, if this was a property episode, we'd have lots to talk about because I've just come from a lunch meeting with a bunch of other guys, and some of the stories they've got are pretty crazy at the way that property's selling sight unseen to Victorians at the moment. But we might
Wow.
have to cover that next week. But on today's show, we're talking about how to pay your home off sooner. And I think that's something that anyone who owns a home would probably want to know. So, mate, why did you want to talk about this topic, and what do you got to tell us?
Well, Scott, it is a topic near and dear to my heart. Getting out of debt, paying off debt is certainly something I am very passionate about with helping my clients. But one of the things I've been noticing, and maybe it's just because of the industry I'm in, I've been noticing, particularly in my Facebook feed of late, are a number of people who are advertising paying off your home in 7 years or 10 years, this sort of thing. And generally, I wouldn't get too riled up over this stuff, but of late, it's really started to bother me. I've been in this industry 20 years. I've seen a lot of good things and bad things, and I really find that these sorts of advertisements on Facebook suggesting that someone can pay their home loan off in 7 years, and it's really easy to do it and all this kind of thing, is really misleading. In fact, it's borderline scammy. And I just wanted to, I think, get back to basics and say to people, yes, you can pay your home loan off in a very short period of time or a shorter period of time, but it isn't as simple as maybe what some of these people out there on the World Wide Web would lead you to believe. So it's just a topic I wanted to broach, especially in light of the current economy, and people are probably feeling, maybe financially under a bit of stress, that sort of thing. So I thought it might be a good topic just to, get back to some bread and butter stuff and have a chat about it.
And it looks like you're broadcasting from outside your home in where are you?
Well, I'm definitely outside someone's house. I'm not sure. I think we're outside a nice little bungalow in California, based on the palm tree here on the curb. It's definitely a U.S. style house. I can't tell if the car in the garage there is right-hand or left-hand drive, but I think we're broadcasting from certainly a very nice looking neighborhood on a very sunny day indeed.
That's what I was. It looked very sort of Mexican inspired there. It looks pretty cool. So, all right. So, you've alluded to paying off debt, and the biggest debt that pretty much anyone ever has is their home loan debt. Now, it seems like a monster. For a lot of people, it's easy to pay off a little bit of credit card debt or a fridge or a vacuum cleaner or a personal loan or something like that. But it comes to the home loan, and you don't think in months, you think in decades. So how do you propose to pay it off quicker, mate?
Well, just before we get to that, I thought I might touch on, because I brought it up, I thought I might touch on some of these ads and things that you do see around paying off your home sooner, and just maybe, I don't know, give people some warning or a bit of understanding about how these things work. So effectively, that strategy, and it is a strategy, and I'm not saying it doesn't work. It's probably not as great as what they lead you to believe, but it effectively involves you buying an investment property, having the rental income from that property go into an offset account or straight into a redraw. And effectively what they're trying to do is pay off your non-deductible debt at an accelerated rate, and then you're left with fully deductible debt. So your overall debt level doesn't actually decrease. In fact, it goes up initially, and then I suppose if you're very prudent and good at paying off debt, then of course you can see that shift occur between non-deductible and deductible debt. That's a topic we can certainly cover off at a later stage, maybe in another update, about some of these strategies about paying off, creating tax-deductible debt from non-deductible debt. But to your specific question, there's a number of ways to pay your home loan off sooner. And you know what? It boils down to, it's very simple. Wait for it. Make extra repayments. I'm going to go in today to how you can do that. And I'm actually going to show you in a moment. We'll share the screen. I'll show you a very basic calculator that I use to illustrate this. But before I do that, of course, you can typically jump on any bank's website. They'll have an extra repayment calculator. You can just Google that. You'll find the Mortgage Finance Association of Australia, the Finance Broker Association of Australia, lots of places where you can actually go and find a calculator where you can punch in your own numbers. But it really boils down to this, Scott. If you want to pay off any debt at an accelerated pace, you have to accelerate the repayment. It's really that simple. So let's get into some strategies on how to do that. So the first one that is oftentimes well overlooked, even by people in my industry, is make a weekly or a fortnightly repayment. So even if you don't make extra repayments, if you pay more frequently on your principal place of residence debt, then you will effectively reduce the principal faster, because as a home loan debt, interest is calculated. It's calculated every day. And if you have reduced the principal on your home loan every week, so you're paying 4 times a month instead of once a month, it reduces the amount of principal that the interest is being calculated on. Now, it's small amounts of money, but it would add up over a long period of time. That's the first thing. So a weekly repayment, or for those that maybe get paid fortnightly, a fortnightly repayment. That in and of itself will accelerate the repayment of your debt, and I'll show you that in a moment.
All right. So you tell me when you want to share the screen, mate, because I can see it here behind the stage and the backstage. Okay. And if you want me to drag that on, except I think that I can see you on it, so I don't know how that works. But anyway.
Okay. Well, we'll do that in just 1 second. I'll just run through 2 more quick things, and then we'll just do some quick scenarios, and then we can do some Q&A on this. So paying weekly or fortnightly, increasing the frequency of your repayment. That's a very simple way that most people can do without actually paying extra. You are making an extra repayment by virtue of paying more frequently. I hope that makes sense. Bit of a wordplay there, but hope that makes sense. Second thing is, and many of you would have heard of these, but utilize an offset account. So if you have a home loan that has a bank account attached to it, there's a very good chance that your lender has it's a feature of the bank account called offset. And all that really means is that if you have, let's say you have a $100,000 mortgage, if you had $50,000 in your offset account, which is a bank account, they would calculate the interest payable on the loan only on $50,000. So again, $100,000 mortgage, $50,000 in the offset, you're only going to get charged interest on $50,000. This is a very powerful way to, again, accelerate the repayment of the principal, because you're not making any extra repayments. You're just utilizing any cash you have available sitting around by offsetting your home mortgage. So that's a very powerful strategy. The other way to do that would be if you did not have an offset, and there are a lot of lenders that have basic products that don't have offset features because they're not banks. They have redraw. So you can actually put the money directly into the loan account. You can salary credit as well. So again, you're making more frequent payments into the home loan account, and you're also building up the redraw. Again, the effect of this is that you are reducing the principal amount on which interest is charged. So one of the key things to paying off a home loan sooner is to build up the principal balance and reduce the amount of interest being charged. So the third thing would be for those of you who earn lots of money like you, Scotty, and might get a bonus, or maybe you get a tax refund every year for whatever reason. When you get those lump sums of money, don't go down and buy something like a toy or whatever, or go on a holiday. Be prudent and smart and whack that into your mortgage. And again, as I said earlier, we can talk another time about strategies to recycling debt and creating tax deductible debt and how to invest that. So we'll stay on point today and on topic and talk about our reduction of our mortgage debt. So if you want to flip on the share screen now, hopefully you see a screen with a lovely looking blue and dark blue and light blue chart? Okay, cool. So what I thought I would do is just run through some basic assumptions. And if you think these numbers are too high, please do let me know. But now I'm in Sydney. You're up on the sunny coast. So I picked a loan amount here of $700,000, which may or may not be about the average mortgage, but it's probably not too far off. The average term that most Australians choose is a 30-year mortgage. And right now, I mean, we could argue plus or minus this number, but a good variable interest rate right now would be around that 2.59%. So at the moment, I've only got this set up on a monthly frequency with $100 a month extra. Now, just in doing this, you're going to, as you can see here, save 1.5 years, off your mortgage. Not a lot, but at least you're saving 1.5 years. Now, if you look here, it is a lot, actually, and it does add up over time. But if you look at the repayment, now focus on this repayment amount. I'm going to do another trick, which I didn't mention a moment ago. Again, this is an overlooked strategy. Most people just default to a 30-year mortgage. Watch this repayment, $27.99 a month. Not a huge amount of money, not small, not large. But if we take this mortgage loan term down to 25 years, it pops the mortgage up to $31.72. So what was the other one? I think it was
2,800, I think.
2,800. Okay, so 2,800 to 3,172 is what? $370 per month. Just in reducing the term by 5 years, you can again, you can knock off 5 years, but you'll actually knock off 6.1 years because here you've saved another 1.1 years just by making an extra $100 a month. So effectively, what you're doing there is making about a $480 or say $500 a month extra repayment. But a lot of people base their mortgage repayments off 30 years. So again, just in reducing the loan term from 30 to 25, yes, your repayment does go up, obviously, but again, you save 5 years off the mortgage right there. Now, let's do one other quick thing here. Let's increase the frequency to a fortnightly repayment and see what that does. Just by making, and I haven't changed the additional repayment. We've set it at 25 years. I'll go back to 30 so that we're maybe talking what the typical person might do. But anyway, let's go back to monthly. Let's reset everything. So 1.5 years, just by going to a fortnightly repayment, only making a $100 additional repayment, 3.1 years. It doubles. It actually doubles just by making an extra 26 payments.
That's $100 extra a fortnight?
A fortnight, yes. $100 extra fortnight, so $200 extra a month. So barely changing any of the metrics. People could do this. $100, a fortnight is probably, don't have lunch, don't buy lunch twice a week or whatever. It's not a lot of money. Don't go to the pub, twice a week, just go once a week, something like that. It's really not a lot of money when you think about the grand scheme of things. Now, if you were to increase that to a weekly payment, and again, this would mean $400 extra sort of per week, you actually knock off 5.6 years. You almost add another 2 years of additional years saved off that mortgage. So as you can see, increasing the frequency of payment makes a huge difference. So I'm going to go back to a fortnightly repayment, and I'm going to actually reset this to 25 years because I think we can agree that that really isn't too much of a stretch for most people to work within those metrics. So let's just quickly look at some additional repayments of larger sums. So $100 a fortnight, again, that's not a lot. $200 extra a month for all intents and purposes. Let's crank that up to say $300 extra fortnight. Now we're talking, this is a little bit more serious in terms of the amount of extra money you have to put towards a mortgage. But as you can see now, it's dropped off another, I didn't watch to see what that went to from 100 to 300. So what do we do? 2.2 years. Just by popping that up to $300, you go to 5.6 years. So again, quite a significant saving just by increasing the amount of additional repayment that you're making. Now, let's say you really got crazy and you actually had a lot of disposable income and you could do $500 extra per fortnight. And I do actually know people that do this, people that are on overtime. They might be nurses or work in some industry where they get mandatory overtime payments, that sort of thing. So they have the extra cash flow to do that. You can actually, as you can see, reduce your mortgage term. And that's what this chart here is resetting, is this big blue line here is showing you when you actually pay off the mortgage. So you would pay it off in sort of 16 years. as opposed to a 25-year term doing nothing. That's some pretty powerful stuff, if you ask me. So we've gone through a lot of numbers there.
Good.
And I guess the moral of the story is don't get lazy about your mortgage and your mortgage repayment. As you can see, for very small amounts of additional repayment, you can make a big difference in your mortgage balance and how many years it takes to actually pay the thing off. And we know that Australians are very good about paying off their mortgage anyway. So this is just one of those tips, I suppose, on how to make a big difference. And the cool thing about this, and again, I think we'll have to save this for another time, once you build up some equity in your home through making extra repayments, we can talk about strategies down the track to actually pull that money out and invest it, give it to a guy like you to put into a property project and get 10, 15, 20% return on that money. And then you can slap some more lump sum onto your owner-occupied mortgage and really pay it down even faster.
Yeah, no, that's some really good stuff there. So the best way to pay off your home loan is just to pay that little bit more and more often. I mean, that more frequency and the more actual dollars makes such a substantial difference over time. Next thing you know, it's 3, 4, 5 years sooner and you own your own home.
Frequency is the key. It really is the key. The amount of money isn't as important as the frequency. So again, even if it's a small amount of money, even if all you can afford is $50 a fortnight or $50 a week, please consider making that extra repayment into mortgage. Here's another reason why you might want to do that. If you think about it this way, what's the interest rate, Scott, that you've seen on an at-call bank account at the moment? So just you trundle into your local NAB branch and you put some money in the bank. How much interest do you think they're paying at the moment for bank accounts?
I don't know, because I just would believe it'd be so low. But I mean, if you're getting 1 or 1.25%, you're probably doing okay. I don't know.
Yeah, I mean, it's probably around that. Well, actually, it'd be lower than that for at call. Term deposits are getting that, believe it or not, for 2 and 3 year terms. It's just ridiculously low. But you can probably see where I'm going with this, and that is, if your home mortgage, in this example, we use 2.59%. If your home mortgage is charging 2.59%, and all you can earn in the bank is, say, 1%, well, if you put that money into an offset account or into redraw, it is like earning actually more than the interest rate on the home loan, because, of course, if you put your money in the bank and you earn interest on that, you're going to pay some tax on that interest. So if you put it in offset or you put it in redraw, it's like earning interest at 2.59%.
Okay, so if we got a 1% payment of interest rate and you got money in the bank, you're earning 1% and you pay 30% in tax, just so it's 0.7% is what you're actually getting on the money, whereas what you're saying is at 2.59%. We're getting close to, it's verging on 4 times the amount, mate.
Yeah, and that's because you're not paying that interest to the bank, which is a direct savings to you. And so to pay that interest, you have to earn, probably 30 or 40 more percent just to pay the extra interest in that calculation. So again, hopefully it's clear that if you have extra cash, don't put it in an interest-bearing bank account. If you have a mortgage, that is, put it into either your redraw or your offset account, where, again, your effective interest rate is going to be whatever the rate is that you're paying on your mortgage, and probably a little bit more.
Okay, so so that's the simple, easiest way. You got a home loan to do that, but obviously from that point on, there's some other let's call them two different things. There's going to be habits, and then there's going to be strategies. So if we've got some time left, do you want to touch on some good habits which can help you find the money extra to pay, and then we can touch on a couple of strategies before we've got to call it a day?
Yeah, awesome. Let's do that. So one of the most basic things, habits to get into would be to have a basic budget. And I'm not advocating that you go in and try to budget yourself down to the last cent. That's manic, and I think that's unnecessary. Most people don't stick to budgets like that because they're just too hard to manage. But if you have a broad budget that you can sort of manage, where you're spending X amount of money every month on groceries and X amount on petrol and X amount on entertainment, then you'll know, if you're getting outside of that budgeted amount, you'll probably know it. So sticking to a budget is critical. Now, one of the best ways I've found to ensure that you don't spend extra money in your budget, is to focus on, for example, your shopping. So we all know that every single week, sometimes more frequently, because Scotty, I think every time I talk to you every day, you're at bloody Kohl's. But anyway, a lot of people go to the supermarket.
Mate. I got to eat. I don't know what you're talking about. I got to eat. I got to keep
you got to be fed,
this body.
That's it.
That's right.
That Adonis body of yours, you got to keep that going. But anyway, a lot of people go to the shops, of course, at least once a week to do the weekly shopping. And many people just wander into the shops and then think about what they're going to prepare meal-wise that week. And I can speak from personal experience. A number of years ago, my wife and I began to plan our meals for the week, usually 4 to 5 dinners and so forth during the week. We have a family of 5. And we found that first of all, when you go into the shops, you don't then do those impulse buys, and you don't do those buys where like, ooh, do I have tomato sauce in the cupboard? All this kind of stuff. You have your list, you know exactly what you're going to make, and you go and you stick to that list, and you'll notice that your weekly shopping bill probably will, if it doesn't come down, it will certainly be in a fairly tight range. Now, obviously, there'll be things some weeks that you have to buy, like maybe toilet paper or something, that are going to increase your shop, because you don't only do that maybe once every 2 to 4 weeks. But the point is that just a simple thing of having a shopping list and having a meal plan for the week will actually can save you, I dare say, $20 to $50 a week off your shop.
Yeah, no, that's good. So, I mean, that's a real practical thing, and you can sort of take that to other areas, whether it's clothing and other bits and pieces too, right? I mean, the whole casual shopping, going out for a shop, not particularly something I enjoy doing, unless it's for a car, is probably something that people buy a lot of money on.
Well, they do, and I've been guilty of it. Look, we all have, and that is, you wander into a shop. It could be to buy one item, and of course, they're very clever about how they position products and things like that. And you spot something, and you think, "Ooh, I should have that, or I should buy that." So, I mean, resisting the temptation to succumb to to those sorts of impulse buys, of course, is useful. But I think if you just, we're all going to do it. Let's be fair. We shouldn't be too hard on ourselves. Let's be fair about that. But again, having that budget and sticking to it is, budget for your shop and sticking to it is one of those critical things to do. Another good tip for people is to evaluate your insurances every year. So what I mean by that are your home insurance, your car insurance. Oftentimes what insurers will do is, you see these ads on TV from Budget Direct or one of these guys offering really low insurance rates or whatever. They give you a really low quote, and you go and you take out the insurance. And then a year later, 2 years later, you find that all of a sudden your premium has jumped. And most of the time people just think, oh, well, that's just the normal premium increase or whatever. But surprisingly, and I've done this exercise recently myself, if you go and re-quote with a couple of different insurers, and this is especially true on something like home insurance or auto insurance, you might actually find that you could save $200, $300, $400 on a policy. So that's real money in your pocket. And for the short amount of time it would take you to do that, I think it's worth doing. Same thing with utility providers and anyone where you're paying a monthly service charge or an annual service charge for something like utility or car insurance or home insurance, those sorts of things.
Yeah, I find that with insurance a lot. I mean, there was numerous times where I have gone to check the pricing, found somewhere cheaper, rung up my existing company and said, I'm going over here because they're cheaper. And without even telling them the price, they take you through to the retentions department, and you have that conversation. Oh, you're a good customer. We don't want you to leave, etc., etc. And how about we look at what we can do on your policy? And I've had it about 3 times where they've come in at the same price as the other policy I've just taken out. Right, I haven't even told them the price, dropped back down, that $400 sort of figure, and said, "Oh, well, can we keep your business?" And I'm like, "No, because firstly, I've already taken this policy over here, and secondly, if you really wanted me, you would have done that in the first place. So get stuffed, and I'll call you next year when I'm shopping again."
Yeah, and that's a very Australian thing to do, isn't it? To do that and just say, "Nope, you should have looked after me while I was your customer." And but I guess it's probably for those guys, it's a numbers game, and they recognize that they're probably net they'll get more new customers than they'll lose. But look, let's face it, it's easier to retain a customer than it is to get a new one. So it stuns me that insurance companies do that sort of thing. But you could look at that across a whole range of different products that you should check pricing on every single year. You can even do this on your personal insurances, your health insurance, all that sort of stuff. Just be mindful that if there's anything, especially under something like a health insurance policy, if you were to do that, you might actually lose some benefit of excluding certain things from happening if you took over a new health insurance policy. So I would just be careful about canceling and replacing any of those sorts of policies, or canceling them before you get them replaced, and read the fine print on those. But certainly it's a great way to save some money every year, and it should be done. You can also do that with your home loan.
That's just the that's the financial planning coming out of you, giving all those disclaimers, mate. Thanks for that. Look, I'm going to let you go on the home loan thing, and we'll touch on that. But before we go, we've got a couple of minutes left, and I want you to tell us about the home loan thing you're about to say, and also give us one strategy. We've talked about some habits. Give us one strategy now, which might help you pay off your home loan, and then we will call it a show.
Okay, sure thing. So I was just going to touch on the fact that we are in an unprecedented environment in terms of interest rates. And so it would certainly behoove you, if you have a mortgage, whether it's an investment loan or a loan for principal, a non-deductible or just a principal place of residence, that you ring your bank and you put a little bit of pressure on them to say, and you could just, it could be a little white lie, guys. And that is, I'm shopping around or whatever. What's the best you can do for me? Can you reduce my rate? Chances are your bank will, or your lender will give you a better interest rate than you're currently on, just to retain your business. It costs them a lot of money to find a new customer, as I just mentioned. And so retaining you is much easier. And let's face it, it's probably more convenient for you as well, because you don't have to change your banking. You don't have to go through the process of putting all your financials and stuff together. So if you can stay with your current lender and get a better rate, in my view, that's always, if you don't need to refinance for some other reason, that is, then that's always a good thing to do. So strategies, right. I alluded to a really good strategy earlier, which is something, a term I use, which is debt recycling. And probably, 50% of people I talk to have never heard of this strategy. And it's very simple. I'm an advocate of the fact that you only really ever need to own one property, and it should be your home. It should be the best possible place you can buy, that you can afford. Pay that thing off as soon as you can. There's some other reasons for that, but the primary reason is it's highly likely that the capital growth on a place that you live in is going to be better, because you're going to choose to live in a better neighborhood than maybe you would if you were to invest. So one of the strategies is to, let's say you have a $500,000 mortgage, and over the course of 5 years, using these strategies of extra repayments, you're able to pay off an extra $100,000. So now you have a $400,000 mortgage. Surprisingly, a lot of people don't realize that you can create tax-deductible debt against the home that you live in. So you don't have to go and buy an investment property to obtain tax-deductible debt. All you have to do is have the money that you've borrowed be used to purchase an asset, such as shares, that will either give you some income that'll be taxed, or potentially capital gain that will be taxed. So that's the test that the tax man uses, is what is the purpose of the debt? If it's for investment purposes, it doesn't actually matter where the debts come from, what it's secured against. If it's your personal home that you live in, that's fine. You can still tax deduct that debt. Anyway, back to our example, $500,000 mortgage now paid off to 400. Let's just assume in this example that you can redraw or take that $100,000 out. You can now take that 100 grand out, and we'll give it to you, Scotty, and you'll find an awesome property project for us to put that money into. And first of all, the money is now tax deductible. So your accountant's going to be able to claim whatever the interest is on $100,000 for the year. And anytime when you get the payout of the project or whatever it is that Scotty incorporated at Xenium, invested in, you take that money and you throw it all back into the mortgage and effectively do the same thing again. Such that over time, as you invest money and pay off your mortgage, hopefully you'll be able to recycle 100% of your debt, so that now if you have still have that sort of 500,000, now have all of it deductible, you have your home, and you've got $500,000 or more of assets out there in the world giving you a return. So there was a lot in what I just said, but the basic strategy is pay off debt, redraw it out, create tax deductible debt, invest that money in something that's going to give you a return.
Yeah, that's really good. Debt recycling is a great strategy, and I think you're right. I think might have a topic for a future show, and we can break down 3 specific strategies and go into them into some depth, because there was a lot you said then, and I think that you've probably tickled someone's ears, and they're going to be interested to know more. So, PJ, thank you very much for joining us today. We're out of time because our chats just go so quick, and we can't tie up our global audience for too long.
We can't. They're busy people.
Busy people. All right. Thank you, PJ. So look, if you do want to know any more about debt recycling, some good habits, other bits and pieces, we've had our contact details scrolling on the show the whole time. But feel free to jump on there, give us a call on 1300 66 7789, and we can have a chat to you, or hit us up on the website, www.xenium.property. No .coms.au's, just xenium.property, and email hello@xenium.property. That is it for today. We're telling you how to pay your home off sooner. Thank you for watching live. Thank you for all our listeners there on the Xenium.Live podcast, and we'll be back with another topic next week and some other exciting things that are going on. All right, that is it. Xenium.Live, all things money, finance, and property. I'm your host, Scotty North.